Welcome everyone. Good evening everyone. Good evening. Good evening. Good evening. Good evening. So before we begin, an important thing to announce about Unacademy. All right. So Unacademy is an online platform, as you all know, and there are various subscription available that will help you, not only see live classes but also recorded classes. There is Plus subscription available and Iconic subscription available. In a Plus subscription, you'll get live classes through India's top educators. There'll be structured codes and tests and quizzes. A lot of things and revision sessions will also happen. Very often. Iconic, you'll get a personal coach, printed books, hard copy of the books. Every test series will be evaluated by you, and obviously all the benefits that is there in the Plus will also be there in the Iconic. Now, as far as subscription is concerned, in a Plus subscription you can take 24 months, 12 months or 6 months depending on your convenience, but the longer duration you take, the per month charges will decrease. For example, for a 24-month it will be 1000 per month. If you take 12 months course, then it will be 1500, and for 6 months you'll have to pay 2000 rupees per month. But additionally, whichever subscription you take, if you use this code, this particular code Yashas Life, then you will get additional 10% off on 100,000 rupees this, or 1500 or 2000, additional 10% discount you will receive. Apart from this, we have a mega combat course coming up. Mega combat, basically it's a competition coming up, so for which you can enroll for free. It will be from 22nd August to 29th August, and obviously you can use this code Yashas Live as well in the combat course, wherein uh, there will be prizes for the winners. The first, second and third winners will be given scholarship. All right, it could be either partial or full scholarship that will be given to you. So now let's start with the course. We'll continue forward what we were studying on the. Good evening. I think many of us have joined. Hello everyone. Yes, you do promotion also like teaching, sir. Yes, their promotion is important because many of the students don't know about various courses, so they are in the dark. So this is an important thing that we all have to do. Now, we have studied about previously about different types of disinvestment, privatization. What is the difference between a disinvestment and privatization in the previous sessions? So we have, remember, the three legs of liberalization were the three legs of the economic reforms that took place in 1991 through Rao Manmohan model. It was liberalization, privatization, and globalization. Liberalization and privatization we have already studied. But remember, globalization is also important. But globalization will not be helpful unless the economy is liberalized. So the necessary condition for any economy to invite foreign investment is to liberalize the economy, because no economy, if it's a closed economy or government controlled economy, a foreign firm will never come to go to that country because their investment is not protected. All right, and we all know that India is now a member of World Bank, IMF, World Trade Organization. So there are various provisions which every country who is a member of these international institutions have to follow. For example, protection of investment, creation of atmosphere wherein businesses can flourish, and so on and so forth. So what is globalization? You see, globalization is not only export and import. That people have a very myopic view about globalization. Globalization doesn't only mean export and import. Just hold on, I'll have to increase the width of the pen. All right, so import and export. Globalization is basically integration of the domestic economy with the global economy. So if I have to define globalization, it is nothing but integration of the domestic economy with the global economy. Integration is what? What do you mean by integration? Globalization involves free flow of not only goods and services but also knowledge, information, technology, human resources, and so on and so forth. So globalization in the broader sense is allowing your country to become a part of the global marketplace. There will be inflow and outflow of factor input, inflow and outflow of manufactured goods and services, and inflow and outflow of capital. Clear? So it involves flow or free flow, rather free flow of goods, services, knowledge, information, technology, capital, human resources, etc. Alright. You may not have seen those days, but go and ask your parent before 1991 what was their standard of living. How many goods or substitute of any particular good was available to them. I remember when I was a child that if you want to buy shoe, you have to only buy Bata, and there was some generic brands were also available. All right. Today, if you want to buy, and in the sports shoe category, you had only kits. You have not much of an option. Today, so many shoes are available. All right. Many of the shoes are imported. Many of the shoes are made by foreign firms in India. All right. Likewise, you see, a middle income earning family could never afford a computer, during the 90s. But today, the pace of globalization has increased so much that the production has picked up so much that there is proper allocation of resources. You see, globalization leads to better allocation of resources. How? Leads to better allocation of economic resources. Because I'll just give you one example, and there are many examples like that. You say food processing industry in India is struggling. It was struggling, it is still struggling, but the situation is better off right now. Every year India wastes 30% of its fruits and vegetables. 30%, 30%. That will go into billions of dollars. 30%. Why we are wasting so much? Because we don't have enough cold storages. We don't have food processing plants. We need investment in this sector. And Indian companies, if they want to invest, then the recovery of this capital, what you say, the gestation period is very long. But there are companies in the West which are very good in, they are expert in food processing. So let's say, for example, if in US more than adequate amount of tomato is produced in any particular year, and it frequently happens, the production sometimes increases significantly. What they will do, whatever the people they can consume, they will consume. The remaining will go into the food processing industry. It will be chopped and sliced and diced. Little bit of preservatives you add and put it in a can. Now if you leave tomato just like that, it will rot. But when you're canning it through using preservative and technology, and obviously they are very advanced technology, then you can increase the shelf life of that tomato from 7 or 8 days to 1 or 2 years. And those can be exported to other countries. So now suppose if we allow investment of foreign firms into India and they come to India, all of those firms which are expert in food processing, don't you think whatever wastage is happening, we can also put it in a can, add it a little bit of preservative and increase its shelf life, and we can export it to other countries. We can also consume. So it means if the waste, it reduces from 30% to let's say 5%, there will be some amount of normal waste that you cannot do. Nothing can be done about it. But 30% is too much. If you're saving even 20% of those which are wasted, can you imagine how much of money you're saving for the economy? And not only that, when food processing will come to India, these companies, they will set up plant, they will set up storages. Don't you think it will generate more and more employment? Of course. So aren't we allocating resources properly? Isn't it? So it leads to better allocation of resources, and due to better allocation of resources, what happened? It will have a direct impact upon the GDP of the country. It will increase because consumption will increase, competition will increase, government revenue from taxes will also increase. Living standard of the people will increase, more employment will be generated. So today no country can follow a closed economic model. So it was a blur to me. All right, clear. So that's what globalization is all about. Now, if you go back here, you see globalization helps in, obviously, it helps in a lot of things. It helps in better allocation of resources, all right. It also helps in advancement in technology, When foreign firms come and they will produce here, we'll also learn their way of doing things. There'll be a technology transfer. All right, it will lead to increase in the GDP of the country. It will lead to increase in employment opportunities. And so on. There are many things or many advantages of globalization. But yes, domestic industries have to be provided some amount of safeguard. We'll come to that safeguard, what it is. Now, when you're talking about globalization here, FDI and FPI play a very, very important role. Now, when I talk about rationalization of tariff structure, this is related to tariff structure. It means the rate of import and export duty. We rationalize. I told you the peak rate of custom duty before 1991 economic reform was 125%, which was reduced to 10%. Now 10% not for every commodity, but for most of the commodities. If you today want to import a luxury car, the government will take a very high amount of tax. Government may take even 100%. Because why you want to buy when you can afford to pay 2 crore rupees or 3 crore rupees for a car that you are importing, you can pay another 2 crore rupees to the government. So there the import duty have not come down significantly, but agricultural equipment, raw materials, medical equipments, medicine, on these you cannot charge a very high rate of taxes. Alright, so it was rationalized. As a part of globalization, we decreased significantly the rate of taxes, the peak rate of customs duty. Alright, peak rate of customs duty was reduced significantly. Now let's learn something about FDI and FII. What is FDI and FII? Because you will be getting a lot of questions from here. What is FDI? Alright. See, FDI stands for foreign direct investment. FDI stands for foreign direct investment. Foreign direct investment. Now, how you can define FDI? See, a foreign multinational firm which belongs to some country, some other country, rather than exporting the goods to the host country, they will try to set up their plant in that particular country. There are various benefits for it. What is the benefit? First of all, the government in which you are investing, they are going to provide you a lot of amenities, free land, this and that. You don't have to pay such a high rate of customs duty. If that country is a developing country, you will get cheap labor, your production cost will come down. When you're not exporting, your shipping cost, warehousing cost, this will also significantly reduce. So overall, it will reduce your cost of production. And so when it reduces your cost of production and you pass some of the benefit to the consumer in the form of decreased price, the demand will increase. Let me give you an example. Pepsi. Is it an Indian firm? No, it is an American firm. American firm. It's a firm registered in the United States of America. Now, for Pepsi, when the demand for Pepsi in India, it is significantly high, it is better for Pepsi to come and produce here. So what Pepsi will do? Pepsi will bring capital to our country, It will set up its plant and machinery here. It will employ Indian labor. It will purchase its factor inputs, raw material like sugar and other things from the suppliers in India. When the goods are produced, they are distributed to length and breadth of the country. They will be using the transportation services, obviously in our country. And when these bottles of Pepsi are sold, the government is going to receive the GST from Pepsi. It means, despite Pepsi being a foreign firm, when it comes and produces in India, it will be treated just like an Indian firm. Only thing, little bit of provisions different will be there. Government will not say that a cold drink which is produced by an Indian company, if the rate of GST on cold drink it say is 18%, government will not say that a foreign firm selling cold drink, I will take 28% of GST, and an Indian firm selling cold drink, I will be taking 5% of GST. No, this is violation of national treatment principle under the WTO. When a foreign firm comes and produces in your country, you have to treat their goods produced in your country just like you treat the goods produced by your companies in your country, in India. So there will be no difference between a Bindu Jeera drink which is manufactured in India by an Indian company and Pepsi. Likewise, when Vodafone came to India, for a consumer there is no difference. The consumer will go to whichever company which is giving the better package. But Vodafone is a UK firm. When it came to now, they have collaborated with in India with Idea. But initially Vodafone, when it came, and still majority of the stockholders of Vodafone are UK citizens. But when it came to India, do you think they bring people to work in Vodafone stores? Do you find foreigners working in Vodafone store? No. Indians working in Vodafone store. They are renting the place from the property holder who is an Indian. They are selling their services to an Indian. They are competing with Indian companies and they are paying the same tax, same indirect tax to the government as Airtel. So for a consumer, there is no difference between Vodafone or Bharti, Airtel or Reliance Jio. Only thing is that because you are a foreign firm, government may take a little more direct taxes on your profit compared to an Indian company. That's it. And after payment of taxes, an Indian company after payment of tax will distribute the dividend to the Indian shareholders. A foreign firm will take away some of the profit to be distributed to their stockholders in that country. So that is FDI. Now what are the questions? Technology is also important. Is the combination? Yeah, it's the same topic that we studied yesterday here, and we'll continue this topic tomorrow as well. So now you understood what is FDI. FDI, when a foreign firm makes another country, which is the host country, their destination to produce and sell, and they will be treated just like a domestic firm. Only difference is that capital is flowing from some other country to our country. And not only that, you see, what is the reason China has grown so big? Because if Apple goes to China to produce its mobile phones, you see every mobile phone that you buy in India, it will be assembled in China. Why? Labor is cheap. Chinese government said to Apple, you come and produce here, I'll give you free land. Alright, you can cut down on the import duty as well. So Apple went there and produced there. And not only that, it catered to the domestic population in China, wherein they can buy cheaper iPhones. But now Apple is manufacturing in China to sell in other countries. It means for the Chinese government, for the Chinese economy, it is increasing in export. Imagine Apple, an American firm, setting up its factory in China to produce in China and sell in China, but they are producing more so that they can meet the demand of neighboring countries as well, like Sri Lanka, Bangladesh, India. So don't you think it's a win-win situation for China? If Apple comes to India and manufactures here, can you imagine the amount of, or any foreign firm comes here and manufactures here, can you imagine the amount of employment will it generate? And new employment, it means more income is more demand means more production, and can produce more to export to other countries. Export is considered as injections into the economy. It will increase the value of your GDP. That is FDI. Now, there are certain characteristics of FDI that you have to keep in mind. What are these characteristics? First of all, FDI is always long term. I'll make you write that point later on. Wait, FDI is long term. Because tell me, when a foreign firm wants to invest and start a business in some other country, do you think they have an end date? Let's say you want to start a business in India. Do you think there is an end date? Okay, I'm starting, after 10 years I'll shut down my business. No. Till the time you are earning profit, you will continue. You are adopting what is known as a going concern principle. So it is usually, not usually, of all the time, it's a long term. It is non-speculative, because when you're starting a business, you are not speculating. Alright, speculation is always short term, but investment is always long term. It will lead to direct addition of GDP to GDP and direct generation of employment. The examples I gave you just now. Pepsi, you see, Indian people are working in Pepsi. If the demand for Pepsi increases, and that means it will generate more employment in India. So Samsung is heading towards, sir, already has its largest screens producing factory in India. Yes. So who is getting employment? Who is working in Samsung factory? Chirag. Who is working in Samsung factory? Do you think Koreans are working in Samsung factory in India? No, Indians are working. If suppose the demand for Samsung phones increases in other parts of the world, and Indians can help Samsung to produce better phones, then don't you think Samsung will bring more investment to India? It will help our economy. And we are exporting, we are earning foreign exchange. We are earning dollars, which will appreciate the value of our own currency. Alright. So it's long term, direct addition to GDP, direct employment generation. Direct employment generation. But what is FII? Sometimes we call it FPI, foreign institutional investment or foreign portfolio investment. FII is also leads to inflow of capital. Alright, but there is a difference between FDI and FII. Foreign institutional investment. Sometimes we also call it as foreign portfolio investment. What is it? Let's forget about foreign investment. Let's understand this concept here. You see, I can make money through multiple ways. Alright, I can start a business, I can set up a factory, I can employ people, factor input goes into the factory, output I can distribute and sell. This is a normal course of doing business. But don't you think I can also, rather than starting up my own business, buy equity share of companies who are already doing business? Are you getting the idea? It means I become the shareholder of some company. So if I think that HDFC has a great prospect of growing in India, I will buy HDFC shares. If I find that, okay, ICICI Bank has a great prospect of growing in India, I'll buy ICICI Bank shares. If I find that Dr. Reddy's have great prospect and it will get more and more, export orders from different countries, I will buy. So it means I'm not starting a business. I'm not starting a business. I am simply trying to ride on the already running business. I don't have to take the mental trauma of arranging factor input, putting people to work, thinking about how much of profit I'll make. So I will simply ride along the already established company. This way I can also invest. Correct? Right. That's the difference between a foreign direct investment and a foreign institutional investment. In a foreign direct investment, a foreign firm will invest in India, bring its capital in India, start manufacturing in India, start selling in India, distribution and everything that we have studied. But in case of foreign institutional investment and foreign institution, it could be a body corporate, it could be a mutual fund company, it could be a bank, it could be an investment bank, it could be any institution. If they think that this particular Indian company is going to grow phenomenally in the near future. So what they will do, they will through the capital market purchase equity shares of these companies, purchase bonds of this company. They can also invest in to buy government bonds. So are they directly participating in any business? Tell me, if you buy Reliance Industries shares, do you participate? Do you phone Mukesh Ambani and say, oh sir, you are not running the business well, share price is going down, do that? No, you don't do that. All right, clear. So they will invest by buying through the capital market route. And if suppose what their purpose is to get capital gains, to generate more wealth. If suppose they purchase HDFC shares and the price of shares increases by 400 or 500 rupees, they will sell away the entire equity or some of the equity to book some amount of profit. Not only that, when the HDFC bank distributes dividend, then a foreign institutional investor will also receive dividend just like Indian investors receive dividend. And if the companies, if they want to get rid of their investment, they can sell. So foreign institutional investment is not long term. Because tell me one thing, if say for example Citibank purchased Reliance Industries shares at 2200, the price went up to 4000. Will it continue to hold it? Some maybe, but many will book profit and exit. Many will book profit and exit. But if it's an FDI, you are earning more profit, will you shut down your business? Do you think if Pepsi is earning more profit, they have come through FDI, they will shut down the acha profit ho gaya, I'll shut down my business? No. So they will book profit and they will leave. They will leave. It will lead to sudden outflow of capital that becomes very, very risky. That is the reason when foreign stock markets fall, there is a liquidity problem in countries like US or European countries. Then those foreign institutions who are holding equity shares in India, to take care of their liquidity problem over there, they unload their financial instruments in India. And that leads to fall in the stock market. When the stock market is falling down, the domestic investors, they panic, they start to sell. That is just like adding fire, adding oil to the fuel to the fire. And there is a market crash that can happen. So that's why government considers FPI or FII. FPI, foreign portfolio investment, or FII means the same thing. FPI you can also call it, not FDI, FPI. Government calls it as hot money. You may not have heard this term because as I've told you, you have to start reading the newspapers, especially business newspapers, anyone you choose according to your convenience. But get into that, at least read the front page news. Government calls it as hot money. Why hot money? Because it is very volatile. Very volatile. Why very volatile, you tell me? When Pepsi is doing business in India, when Apple has set up his factory in India, when Samsung has set up his factory, when Kia and Hyundai is manufacturing in India, when Mercedes-Benz is manufacturing in India, is it possible for them to one fine day wind up this business and leave in one day? Is it so easy to wind up a business and going on an ongoing business? You have so much of assets and liabilities that you have to take care of, so many physical infrastructure you have to take care. It means overnight it can happen that Pepsi is shutting down its plant. Is it possible? Not possible. But how long will it take for a foreign firm to sell equity share or any financial instrument that they are holding in India? How long will it take you to sell away any equity share? Sale order, enter. Market is open, the sale has happened. Alright, 5 seconds will take you to withdraw your investment. Alright, whenever the stock market time is, from 9 to 3:30, 9:15 to 3:30, you can straight away enter your order and exit, you'll exit. That's why it's very, very volatile. Very, very volatile. So if government is allowing foreign investment, when government says foreign investment, say for example, if government says I'm allowing foreign investment to increase in India, foreign investment, this consists of both FDI, please pay attention, both FDI and FII. But government, if it's allowing for FDI, let's say government says 51% foreign investment in any particular sector I will allow. Let's say insurance sector 51% government will allow, 49% government will allow. What is this percentage? I'll tell you later on. Then majority three will be through FDI. If government is allowing 51%, then consider this, that around 40% or more, 40% or more, there is no clear-cut rule with regard to it, but 40% or more will be through FDI route, and 10 or 11% or less, 10 to 11% or less will be through FII route. Why? Because to tell me logically, do you think government will promote a business model which is more stable and long term, or do you think government will promote a business model wherein inflow is happening for a short term and lead to speculation? You tell me. It will be long term, right? Sir, what is it? Sir, I thought India is developing at a good scale financial technologies and infrastructure. Why exchange rate of dollars and other foreign currency increases? There are a lot of things there for it. I teach in detail about foreign market, foreign exchange, how this foreign currency is determined. It requires a lot of things. It means this particular topic about foreign currency, why it is falling, why it is increasing, what leads to fall. This is a discussion that I do for 5 hours, 5 to 6 hours. Right? The lot of diagrams that I also use. So I cannot explain it to you right now here. Why it happens. Alright, I will explain it to you, don't worry. I will meet you as your intermediate faculty as well, and I sometimes also show my students how you can trade in forex using live trade in the classes. So don't worry, I will tell you how it happens and everything happens then, so don't worry. Right? So there is the multiplicity of reasons for it. There is not one reason, there are around 20-25 reasons for the devaluation, depreciation, appreciation and revaluation of Indian currency with respect to foreign currency. Alright, you have to understand the concept of vehicle currency, direct quote, indirect quote, unique rate. There are various types of currency management system, crawling, crawling rate, you have hard peg, you have soft peg, right? You have crawling band. So many things are there. There are a lot of things that plays an important role. So वो बाद में हम लोग पढ़ेगा. I will teach you each and everything in your intermediate. Don't worry. It's a part of your syllabus in your intermediate. Very, very interesting. So for now, let's understand this. Obviously, government will promote more of this. Clear. So if I have to find out what are the clear distinction between an FDI and FII, FDI and FII, FDI and FII. First of all, FDI is long term, whereas FII is short term investment. Long term investment and short term investment. FDI is non-speculative. Something that is long can never be speculative. If you are buying any equity to sell it in a matter of 1 month, 2 months or 3 months, that is speculative. But if you are buying equity as an investment, you are buying mutual fund as an investment, we are going to hold for 5 years, 10 years, 15 years, 20, that is not speculative. Alright, so it is non-speculative. Alright, any question you have here? Non-speculative, this is speculative in nature. Third, it directly affects the GDP. It directly and positively affects the growth in terms of GDP, isn't it? When foreign firms come here, they will generate employment, they will produce here in India, they will use factory input to be purchased in India. So don't you think GDP is what? The market value of all final goods and services produced within the domestic territory of any country. So when a foreign firm comes and produce here within our domestic territory, don't you think it will add it to our GDP? And they are generating employment. But it is not going to affect GDP in any manner, because this is simply transfer of fund that is happening. For example, I'll give you an example. You see, under the national income, trade in shares is never accounted for in the national income. Why? Otherwise, it will lead to double counting. For example, Zomato IPO came and Zomato IPO was sold in the market. For the first time when it was sold in the market, people who subscribed to those equity share, the money went to Zomato. And with that money, Zomato will expand its business, take care of its liabilities, whatever they want to do, all right, to run your business. But those equity shareholders, let's say I have purchased some equity share of Zomato. I've got it through IPO, allocation has happened. My money has gone to Zomato. Now Zomato share prices have increased. If I sell those shares in the market, do you think Zomato is buying the share? Or some other investor who thinks that the price may further increase, they are buying the share? Zomato is not doing a buy, unless they are doing a buyback of equity. That do not frequently happens. Alright, so it means somebody else is buying the equity. So tell me, it is simply a transfer of shares that is taking place in the stock market. Is it going to generate any kind of employment? Is it going to generate any kind of employment? When I sell some equity share in the stock market and there is a buyer who purchased the equity share, then he sells to somebody else, then again he buys, then he sells to somebody else, then he buys. Do you think the money is going to the company? The money was already gone to the company when the first time the IPO was released. So it is not going to add to the GDP of the country. Alright, it will only, it will do what? It will generate some money for the equity shareholders. Right. So it does not have an effect upon the GDP. Now FDI doesn't mean only fund comes to India. Do you think if Tesla comes to India and manufactures its cars, they will use Indian technology? Or do you think they will bring their own technology? They bring their own gizmos, own plant, obviously disassemble it, and they will try to set the plant here. So it means FDI doesn't only involve flow of fund, it involves flow of fund, flow of technology, and flow of other resources into the country. All right, it involves flow of fund, that is nothing but capital, technology, all right, then other factor inputs. But here in case of FII, a foreign institution is buying financial instrument from the Indian capital market, only flow of fund happens. Only flow of fund takes place. FDI cannot be easily withdrawn. It takes time to sell away your plant, machinery, and wind up your business. Cannot be easily withdrawn. It can be withdrawn, but not that easily. Vodafone is trying to wind up his business and leave. Is it able to do it? No. It's got a lot of liabilities to pay. But this, it can be very easily withdrawn. Now you know the difference between, sir, what? Islamia, Arabia, Nigeria, Colombia, Australia, Romania, Mongolia, yeah, all over the world, they are fans of Sir's teaching. What are you saying? I don't get it. Why? Okay, anyways, so it will be very easily withdrawn. It can be very easily withdrawn. So now you know what is the difference between now when you read the newspaper and when you see that FDI is coming to India, FII is coming to India, FII or foreign portfolio investment is coming. Why we call it portfolio? Because a foreign firm will not only invest in equities. They can buy some equity share of some companies, they can buy some debentures of some company, some pref shares of some company, some government bonds. So when you collectively see the investment made by a foreign firm into through the Indian capital market, it into various chunks. This is known as portfolio. All right, sir. Nag Panchami में this is Prajwal sir using others phone. All right. Anyways, so please, the students who have not yet subscribed, don't mind my students. All right. They just they're very good and they just mean a little bit of fun. So all right, this is clear. All right. So now you see here many a times when you see government allows FDI, government will not allow 100% FDI. Now pay attention to this because it's very informative. Many a times you hear no, that government is allowed 26% FDI in the insurance sector, which the government has increased to 49%. The government may increase 51%, or government may also go for 76%, or government can go for 100% FDI. What is the meaning of this percentage? Why is it so? If you may be thinking, sir, if foreign investment is allowed, government is allowing, then why not allow foreign firms to completely come? Why this kind of restriction that only 26% FDI will happen? Let me give you an example of insurance sector in India. First of all, when government says that 26% FDI is allowed in any sector, it means a foreign firm who wants to start a similar business in India, what they are doing in other countries, they cannot start a standalone business. It means even if they start a standalone business, it means they have to allow Indian firms to hold 74% of the equity. If government is allowing, let's say, if I'm taking 26%, if I'm holding 49%, it means government can allow you to hold 49% of the capital, but 51% must be held by an Indian company. Why does it happen? If government would have allowed 100% FDI, then there can be a standalone insurance company. You will never find in India a standalone foreign insurance company. You can find a standalone Indian insurance company. You have, LIC, all right, Life Insurance Corporation. You have New India Insurance, right? You have Oriental Insurance. These are standalone insurance company. Insurance companies are also there in the private sector. But a foreign company, if it wants to start up a business in India, they have to necessarily collaborate with an Indian company. That's why you find ICICI Lombard, ICICI Prudential not an Indian company. Tata AIG, Tata is an Indian insurance company, AIG is European. All right. You have Bharti AXA. You will not find only Prudential insurance company. You will not Bajaj Allianz. Bajaj Indian, Allianz, again a foreign company. You will not find only Allianz Insurance Company. You will not find only Prudential Insurance Company. You will not find only AIG Insurance Company. Why? Because government has not allowed 100% FDI insurance sector. If 100% is allowed, then a foreign firm, they need not collaborate with an Indian company to run any kind of a joint venture or through a merger or whatever whatever model they can adopt. Now why the government does it? To safeguard Indian businesses. Let me give you a highlight about Indian insurance company. You see, largely Indian people were obsessed with life insurance. If you go to 70s, 80s and 90s and even 2000 era, people, normal household in India, they will never take in medical insurance. Maybe out of 1000 household, 10 may take. All right, that's not even 1%. That 10 means 1. So it means 1000 may 10 you are taking 1% or less. Why is it so? They used to take life insurance. Why is it so? Because the premium was very, very high. But if you ask me whether the egg came before the chicken came before, the reason why premium was very high because people were not buying insurance. Dono thing. How do you think insurance companies pays you your medical bill? Insurance company will collect small chunk of money as premium. I take an insurance, I have to pay, let's say in a year 25,000 rupees, and the company will give me 10 lakh rupees of coverage. Likewise, crores of people will take insurance, but everybody is not going to fall sick. So you are collecting small chunk of money from a large group of people. Every one of them is not going to fall sick. So whoever are falling sick, you have to give money, but you got the chunk of money that can be invested somewhere else that will give you return also. So those who are they are hospitalized, they are falling sick, they are going to the hospital, they are have to be reimbursed their all medical expenses, reimbursing. So you are collecting more from large segment of the people, small chunk of money, aggregate is very high. You are giving away insurance to a small group of people who are falling sick. The remaining, whatever is left after deduction of operation cost, will be operating cost of the business. You are running the business, employee salaries and everything you have to give, is the profit for the insurance company. But you tell me, if very few people are taking insurance, do you think insurance company will be able to pay for the medical expenses? No, it will incur losses. So the insurance premium was very high. During 90s, if I have to take a 2 lakh rupees medical insurance, I have to pay close to 35,000 rupees as premium every year. Now a common man will think, what are the chances of me falling sick? What are the chances of me falling sick? Let's say I am paying 25,000 rupees for a 2 lakh rupees policy. It means if I don't fall sick in 8 years, then my money is gone. My money is gone. Unless I fall sick, I'll not be able to recover that money. But if suppose I invest this 25,000 rupees in FD, bank FD, in 8 years of time, I will have 2 lakh rupees. If I don't fall sick, the money is mine plus the interest is mine. If I fall sick, then money is still there. So I'm getting so many questions here, sir. If we start ambassador's company and by improving it and asking permission of government, and if guarantee, will it make it affordable and very good performance car? Then it can be done there, but the thing is, these companies have a lot of liabilities. When you take over the manufacturing of these companies and you acquire these companies, you have to pay up the liabilities. That's why many companies will not go for it. So if you want to start, then same is there. All right. So what happened now? Now most of the insurance company, people were not taking insurance, so many of the insurance companies were running at a loss. Now imagine if government would have allowed 100% FDI in foreign insurance sector, then those foreign firms will not have to collaborate with Indian companies. They will come here, Alliance will come here, AIG will come here, Prudential will come here, AXA will come here, and they will start away selling insurance at a cheap price. Do you think Indian companies who have been incurring losses, they will be able to compete with these foreign firms? No, they'll be wiped out or they will be acquired by the foreign firm. So what is the outcome? Outcome that entire insurance sector will be hijacked by the foreign firms and will not have in India any company selling insurance to Indians, which is an Indian company. Is it a good situation wherein everything is sold by a foreign firm? No. So government said what? Government said that foreign firms, you want to come to India, no problem. I will make it easier for you to come to India. You can come and collaborate with an Indian company. Now a foreign firm comes here in India. It finds, let's say for example, Allianz comes or AIG comes. AIG finds out Tata, okay, I will go with Tata. AIG pumps 26% of the money into Tata. It acquires 26% of the equity. But this investment is only not purchase of equity. They are purchasing the equity not from the Tatas. They are purchasing the equity, and they will become a part of the board of directors. They will jointly run this company. Now it's a win-win situation for both of them. Why? Because AIG will get a new market, Tata will get more fund, people will get their premium reduced, And when more and more foreign firms, they will come and pick up one individual Indian company that they will collaborate with. It will lead to increase in competition, and due to increase in competition, what will happen? The price of insurance will reduce. More and more people will take insurance today. So many, almost every household in urban India, if they are in the middle income earning categories, don't you think they take medical insurance? Why they are affordable? Why they are able to take? Because the premium of insurance has come down significantly. Today, if you are around 30 years old, then you have to pay just 25,000 of premium and you will get a coverage of 15 lakh to 20 lakh rupees. Imagine, sometimes back you have to pay 25,000, you're getting 2 lakh or less. Now 25,000, you're getting 20 lakh rupees of coverage, right? So Indian insurance companies started to bloom. The competition started to increase. And when government found out now the Indian insurance companies have become little more powerful than before, their operating profit has increased, then what will happen? India said, now we need more funding. So allow more foreign participation. So government will allow 49% in the insurance. It means now a foreign firm can acquire 49% of the Indian insurance companies. So more funding, more competition, more price of insurance will come down. But when suppose tomorrow government finds out that Indian insurance companies have become giants, they are free, they are strong enough to give competition to the foreign firms, then government can say that okay, no problem, come along, dekhte hain kaun jeetta hai. And then government can allow 100% FDI insurance sector. Now Indian companies are very strong to give big time competition and run for their money to the foreign firms. And the competition will again increase, premium will come down, more people will take more insurance and insurance sector will grow. Remember, insurance sector is one sector in India which is going to grow by phenomenal rate for the next 20 years. So whichever insurance company which has a sound management, you will find that equity share of this company will be traded at 2 to 300% in the next 10 to 12 years. Minimum, that's minimum. Alright, clear. And one of the biggest beneficiary, you will see that ICICI Prudential, ICICI Lombard and HDFC Life. Alright, sir. So let's come to the concept here now. So FDI, FII, you know now what is the difference between it. Now FDI through automatic route and FIPB route. What is automatic route and what is FIPB route? You see, there was a lot of paperwork have to be performed before an FDI can happen in India. If government say for example allows 26% in FDI in India, then even to achieve that a foreign firm have to go through a lot of paperwork, lot of bureaucracy. So it defeated the entire purpose. So government said what? Government set up what is known as automatic route. What is automatic route? Government said that say for example I have allowed 26% or 49% in the insurance sector. I may allow, hypothetically I am taking this figure, this 19%, I can allow 19% from automatic route. Now if government has allowed 49% in one lump sum, 49% participation will not happen. Slowly it may increase, automatic route. Then it means what? That if a foreign firm wants to collaborate with Indian firms, up till they own up 19% of the business, they don't have to take any approval from the government. Any prior approval from the government is not required. It means they can come, say for AIG can purchase 19% interest in Tata Insurance, and they don't have to take any prior approval, no paperwork, nothing required. Only thing is that they have to inform the Reserve Bank of India after they arrive, not even before they arrive. But government say that if your investment increases beyond 19%, which is allowed under the automatic route, if suppose further you want to take it to 49% and you want to increase it by further 20% or 30% more, then you have to take approval from Foreign Investment Promotion Board. This has been done away with, but still they ask you the question. Alright, FIPB. So you simply write this point here, right? FDI can happen in India or can come to India would be a better word. What is happening? FDI can come to India through two different routes. One is automatic route, automatic route. Foreign firms do not require any prior, it means before prior approval, before an investment is made. The RBI, that is the Reserve Bank of India, need to be informed. All right. And second is FIPB route. FIPB also known as Foreign Investment Promotion Board. Right. In this case, a foreign firm need prior approval from the government if the investment increases beyond what is allowed under the automatic route. All right, got it? So ambassador is government company or a private? No dear, ambassador, it belongs to Hind Motors. All right, Hind Motors, they were flourishing because most of the politicians and the government officials, they were given ambassador cars, and government was the big purchaser of ambassador cars. Hind Motors it belonged to. All right, HM likha rahega. It also used to come up with Contessa car. Contessa you must have seen. Hind Motors also it belonged. But when Maruti started to make efficient and lighter cars and more comfortable cars, people started to go with Maruti. And as FDI happened in the automobile sector, then ambassador was not able to spend too much of money on research and development to come out with more efficient cars and which will give you more mileage. One of the biggest problem with ambassador was the mileage. All right, comfort was again, safety was again a problem. So they could not invest much money to do research and development in that, and so it became a dying dinosaur basically. All right. So FDI automatic route. So these are some things. You see, measures were taken towards liberalizing foreign investment. Automatic permission were granted. Just give me 2 minutes. For technology agreement in high priority industries, yes. Automatic permission, high priority technology, for example technology with regard to medical research, production of electronic equipments and so on, automatic permission was given. Removal restriction on FDI in low technology areas. All right, there was restriction on FDI which was removed in low technology area. For example, manufacturing of calculators, or any technology which is not an advanced technology, then foreign firms can come and invest into Indian. For example, Orpat makes calculators. If he wants foreign funding, which was not allowed before, now they can get it. Liberalization of technology imports. Government also liberalized technological import of technology. For example, if I want to manufacture something but the import duty is very high, so government decreased the import duty so that I can bring more and more machines into India to produce. It will be more beneficial to the foreign firms, because when the foreign firms come here, they need to bring their own technology. But the government says, I'm going to take a very high rate of custom duty on the import of technology, they'll never come. So now the government says, no problem, you come and invest into India, you bring your technology, I will reduce the customs duty. Alright. Permission was granted for non-resident Indians and overseas corporate bodies to invest up to 100% in capital and high priority sectors. Who are overseas corporate bodies? You see, these are non-resident Indians, alright, who are holding at least 50% of the equity in Indian companies. They are investing overseas corporate bodies, we call them. Hike in or increase in foreign equity participation limits to 51% for existing companies, and liberalization use of foreign brand name. Now, many times, before 1991 economic reform, foreign brand names was not allowed to be used in India. When the foreign firm used to come, they used to have to use a brand name which is more amenable to people, acceptable to people. Now you can use a foreign brand name as well. 100% FDI in cash and carry and wholesale. FDI 100% in single brand retail. You know what is cash and carry and wholesale? Single brand retail 100% FDI, but in multi-brand retail it's only 51% FDI. You see, single brand retail, for example, if Nike wants to set up a shop in India or invest in setting up its factory in India, they can only sell Nike and it can be owned 100% by Nike USA. But if a foreign firm like Walmart wants to set up its store in India, just like a D-Mart or a Reliance or a Big Bazaar, then they have to necessarily collaborate with Indian company. It means 51% they can hold, but 49% must be held by an Indian company. Furthermore, other things, FDI, what is prohibited and everything, we'll study tomorrow. Tomorrow also you have a session, alright, or your last session on YouTube. For my students who are Unacademy students, we'll continue our special sessions on the Unacademy platform, your special classes, not on YouTube. But tomorrow, because I've got to finish a lot of things with you guys as well, a lot of questions and answers have to be done, alright, a lot of polls, you love polls, I know, we'll be going through it. So don't worry, you've been asking on the group that is this the last class? It's not the last class. You'll have further special session, but on Unacademy platform, not on YouTube. But tomorrow will be, you have one more session from 8:30 to 9:30, alright, wherein I'll try to finish off this particular chapter. Alright, clear? So we'll meet again tomorrow, same time, 8:30 to 9:30. Alright, bye bye, take care, good night.